Okay, so you're trying to get your head around this big new tax proposal from the House GOP. The one big, beautiful bill, they're calling it.
Yeah, it's a lot to take in, definitely. Lots of legislative language to wade through.
We get it. So for this deep dive, we've gone through, well, the early details, the CBO analysis on impacts.
And the actual legislative text, too, from the House Ways and Means Committee.
Yeah.
Yeah.
And our mission really is just to pull out the key stuff, what you actually need to know now about this significant plan.
We want to surface those, surprising bits, the relevant details, without just drowning you in information. Try to make it click.
Exactly. Clarity over overload.
Hmm.
Okay, so let's jump in. What's the first big takeaway?
Well, what's immediately striking is just how broad this thing is. It's not just, tinkering around the edges.
Right.
It's hitting everything, individual taxes, business rules, healthcare, even nonprofits. It's really comprehensive.
Absolutely. And for most of us, the first question is, how does this hit my wallet? So let's talk individuals first. One of the really big items seems to be the standard deduction that's getting attention.
Yeah, they're proposing a pretty significant increase for 2026.
So for single folks, it'd jump to, what, $16,300? Heads of household, $24,500.
And married filing jointly, $32,600. That's a big leap from where it's projected to be under current law.
Right, like currently projected for 2026, it's more like $8,300 for singles, $12,150 head of household.
And $16,600 joint. So, yeah, quite a difference.
Which means, I guess, a bigger chunk of income is tax-free right off the bat for many people.
Potentially, yes. And if you look at the bigger picture, a higher standard deduction often simplifies things.
How so?
Well, fewer people will likely find it worthwhile to itemize their deductions.
Yeah, okay. But it's not all additions, right? There's a trade-off.
Exactly. It's a bit of a two-way street. With this increase, the proposal also permanently kills the deduction for personal exemptions.
Oh, right. That was actually scheduled to come back after 2025.
Correct. So standard deduction up, but that separate deduction for your self-independence gone for good under this plan. Yeah.
Definitely something to keep in mind. Okay, let's talk families. The child tax credit, the CTC, some changes there.
Yes, quite a few. First, they want to make the current $2,000 per child credit permanent.
Okay, and keep the higher income phase-out levels, too.
That's the proposal, yeah. But here's where it gets maybe more interesting.
Go on.
For tax years 2025 through 2028, they're proposing a temporary increase in the credit,
Oh, how much?
up to $2,500 per child.
Wow, okay. $2,500, but only temporary, you said. 25 through 28.
Right, just those few years, which, raises questions.
Like what? The impact.
Yeah, I mean, it would probably give a short-term boost to family finances, maybe spending, but because it's temporary.
Families know it's going away again.
Exactly. So economists will debate if that temporary bump is the best way to help, or if the uncertainty sort of cancels out some benefits. We've seen that before with temporary tax things.
Makes sense. And what about other dependents, like, say, an elderly parent?
Good point. The $500 non-refundable credit for those non-child dependents, that's also proposed to become permanent in this bill.
Okay. Anything else on the CTC?
A couple more things. They want to permanently index the credit amount for inflation after 2026.
So it keeps up with rising costs.
In theory, yes, although it gets rounded down to the nearest $100. And the Social Security number rules are sticking around.
Ah, the SSN requirements.
Yeah, they're actually expanding them slightly. The child, the taxpayer, and the spouse, if filing jointly, all need work-eligible SSNs to claim the credit.
Okay, so that's a continued focus, it sounds like.
Seems to be. Likely an effort to target the credit. Oh, there's one more fairly specific provision.
What's that?
It allows income from a 501(d) organization that's a type of communal religious group
Right.
to count as earned income for the CTC. Helpful for those specific communities
Yeah.
where members might share resources and not get traditional wages.
Got it. Okay, shifting gears a bit. What about business income, like for pass-throughs?
The QBI deduction qualified business income. The proposal is to extend that and make the enhanced version permanent.
That's a big deal for partnerships, S-corp, sole proprietors.
Absolutely. The QBI deduction's been huge since the 2017 tax law.
Yeah.
Making it permanent offers some, predictability for business owners.
Okay. Now, what about people who do itemized deductions? I heard there's a change there, too.
Yes, a pretty significant one, actually, starting after 2025 if this passes. There's a new limit on the benefit you get from itemizing.
A limit on the benefit. How does that work? It sounds complex.
It is a bit technical. Basically, your total itemized deductions could get reduced by, let's see, 2/37ths of whichever amount is smaller. Either your total itemized deductions or the amount your taxable income goes over the threshold for the top 37% tax bracket.
Whoa, okay, let me process that. So for very high earners who itemize a lot.
Exactly. For them, this rule will slightly chip away at the tax savings they get from those deductions.
Kind of brings the benefit down a bit, maybe more in line with standard deduction takers.
That seems to be the idea, yeah. It interacts with that higher standard deduction we talked about. Might push more people towards taking the standard.
Interesting. And speaking of deductions, home mortgage interest.
The current limit on deducting qualified residence interest, that's proposed to be extended. The current end date gets removed, so continued benefit for homeowners there.
Okay. And I saw something about ABLE accounts.
Right, those savings accounts for people with disabilities. The proposal extends the increased contribution limit and makes that enhancement permanent.
Good news for that community. And combat zones?
Yeah, they're expanding the definition slightly for tax purposes, adding places like Kenya, Mali, Burkina Faso, Chad, under certain conditions related to special pay for service members.
So a direct benefit for troops deployed there.
Correct. These kinds of targeted things show they're trying to address specific situations.
Like disaster losses, too.
Yes, the pre-2026 limit on deducting qualified disaster losses would be removed.
Yep.
Could mean more relief for people hit by natural disasters.
And retirement savings. IRA catch-ups.
The expanded catch-up contributions for people aged 60 to 63, that was set to expire. This bill proposes removing that sunset, letting them save more in those later working years.
Okay, helpful adjustments. Now, let's talk about something that sounds completely new. ABGA accounts. What is that?
Yeah, that definitely caught my eye, too. It's a brand new proposal, a pilot program, actually,
A pilot? For who?
for U.S. citizen kids born between 2024 and 2028. The idea is the federal government puts $1,000 into one of these accounts for each eligible child.
$1,000 from the government at birth?
That's interesting. What's the thinking there? Early asset building?
That seems to be the idea, yeah. Maybe addressing wealth inequality, encouraging future investment. The details are still emerging, but it's certainly novel.
Who's eligible, exactly?
The child has to be a U.S. citizen, and crucially, both parents need to provide work-eligible Social Security numbers to get the account opened.
SSNs again? And what if the parents don't open one?
It sounds like the Treasury Secretary is supposed to step in and establish an account automatically.
Automatically. Yeah, though they'd try to consider parental preferences for, like, custodians and investments. And there's an opt-out provision.
Okay. And rules against having more than one, I assume.
Oh, yeah. Rules and penalties for duplicate accounts to prevent abuse. The automatic enrollment is designed for broad reach, though.
And matching contributions. I saw something about that.
There's another pilot program mentioned for matching contributions to some MANG accounts.
Based on what?
Things like where the child lives, their school district. Seems like an attempt to target extra help.
Okay. And how is the money taxed when it eventually comes out?
That's key. Distributions will be taxed to the same rates as net capital gains.
Ah, so potentially lower rates than ordinary income. Encourages long-term investment.
That could be the incentive, yeah. Plus, of course, new reporting requirements, including the SSN rule again.
Got it. Wow, MAG accounts. Okay. What else for individuals? Overtime pay.
Yes, another new deduction proposed for qualified overtime compensation. Pay above the regular rate under the Fair Labor Standards Act. But again, there are conditions.
Right.
You need to provide SSNs, yours and your spouse's, if married, filing jointly. And it's temporary, scheduled to end after 2028.
Temporary again. Who benefits most from that? Hourly workers.
Seems like it, yeah. People putting in extra hours. But it's not a permanent change.
And can you take this even if you don't itemize?
Yes. Both this overtime deduction and that QBI deduction we mentioned earlier are above-the-line deductions. You don't need to itemize.
Okay, that makes them more accessible. Just a couple more quick hits for individuals.
Sure. The income phase-outs for the student loan interest deduction are set to be modified, with inflation adjustments starting after 2026.
Okay.
There's a change related to the clean vehicle credit, specifically for leased vehicles.
Details maybe later on that one.
And a totally new reporting rule for businesses receiving interest on car loans from individuals. Seems like more tracking of auto loan interest.
Okay, technical tweaks, but still impactful for some. Right, let's switch lanes. Healthcare tax changes. Lots happening here, too.
Quite a bit, yeah. One big thing is formally recognizing those individual coverage HRAs, or ICHRAs.
The ones letting employers fund employees buying their own insurance.
Exactly, they're giving them an official name. Custom health option and individual care expense arrangements. Choice arrangements.
Choice, okay.
Yeah.
So codifying what was set up by regulation.
Pretty much. And related to that, an exception allowing people in these choice arrangements to buy insurance on the ACA marketplace, the exchange, using a cafeteria plan.
Which normally you can't do, right?
Generally, no. So this could offer more flexibility in how people use those employer funds. Makes it easier to integrate choice with other benefits.
And there's a carrot for employers too, a tax credit.
Yes, a new employer credit for offering choice arrangements. It's $100 per employee per month in the first year. Right. And $50 per employee per month in the second year. But only if the arrangement provides minimum essential coverage.
So basic ACA compliant coverage might nudge more employers to offer these.
That's likely the hope, especially for small or mid-sized businesses.
What about direct primary care? Those monthly fees to a doctor?
The bill clarifies that money paid for those direct primary care service arrangements counts as medical care for tax purposes.
So deductible or usable with HSAs?
Potentially, yes. Though there are limits on how high the monthly fee can be to qualify, it recognizes that trend in healthcare delivery.
Okay. And this next one sounds interesting. Gym memberships. Fitness expenses.
Yeah, this is a new one. Amounts paid for qualified sports and fitness expenses would be treated as medical care.
Seriously, like gym fees, exercise classes, youth sports.
That's what it covers, yes. But there are caps.
Okay, what are the limits?
An annual cap of $500 for single filers, $1,000 for joint filers or heads of household, and a monthly limit specifically for physical activity.
So maybe that gym membership could finally give you a tax break. That's quite an expansion of medical care.
It is. Could be seen as encouraging healthier lifestyles, maybe.
Potentially. Okay, health savings accounts, HSAs. Any changes there?
A few. An increased contribution limit for folks with family coverage, proposed for 2026 up to $8,300.
More savings room.
Right. And new rules clarifying contributions when both spouses have separate family high-deductible plans.
Okay, clearing up confusion.
Also, a new rule about coordinating coverage under FSAs or HRAs after you take a qualified HSA distribution makes switching to HSA-compatible coverage smoother.
And carryovers for FSAs and HRAs.
A temporary increase in the carryover limit for unused funds in health FSAs and HRAs for 2026 and 2027.
Temporary again.
Yes, and it phases out based on income. Finally, a special rule for certain Purple Heart recipients,
Oh.
allow them to contribute to HSAs even if they have Medicare coverage, which usually isn't allowed, defines a qualified benefit termination month.
So some targeted help there, plus generally making HSAs maybe more flexible.
Seems to be the goal, yeah, enhancing their utility.
Okay, big shift now. Business taxes. What's the headline news?
Research and experimental, or R&E, expenditures. This is a big one for many businesses.
What's happening? I know there was controversy about having to amortize them.
Exactly. This bill proposes a temporary return to immediate expensing, letting businesses deduct the real cost right away.
Oh, wow. But temporary.
Yes, just for domestic R&E, for tax years 2025 through 2029, and importantly, it's not retroactive.
So no help for the years they already had to amortize.
Correct. And after 2029, there are rules about the accounting method change basis. Foreign R&E treatment on disposal stays the same.
So good news for domestic R&E, but the temporary nature.
Creates uncertainty for long-term planning, yeah.
Yeah.
But it's something many businesses wanted. Incentivizes research, potentially.
Okay. What else for businesses? Small businesses.
An increase in the Section 179 expensing limit, the max amount small businesses can deduct upfront for certain assets. Could be helpful.
And bonus depreciation, that 100% first-year deduction.
Proposed to be extended at 100%, but then it phases down starting after 2029.
What's the phase-down schedule?
It goes 80% in 2029, 60% in 2030, 40% in 2031, 20% in 2032, and then it's gone after that.
Okay, so a glide path down. Still encourages investment now.
That's the idea. There's also a special rule mentioned for certain property not previously used in qualified production.
Got it. Opportunity zones. Any updates?
Yes, extending the period to designate new zones for 2 more years. And creating a whole new category.
New category.
Qualified Rural Opportunity Funds and Qualified Rural Opportunity Zones, with rules prioritizing designating these in rural areas.
Ah, a specific focus on rural development.
Seems like it. Plus, new information reporting for these funds and businesses inside them, and specific criteria for designating the rural zones based on economic distress.
More reporting usually means more scrutiny trying to ensure accountability.
Probably. And speaking of small businesses, the gross receipts test threshold is proposed to go up.
Letting more businesses qualify as small.
Yes. And an even higher threshold specifically for manufacturers. Plus, Inflation adjustments going forward helps keep pace with growth.
Okay. What about FDII? Foreign-derived intangible income.
A modification there, but it's pretty specific how it's treated for income connected to a business in the Virgin Islands for certain U.S. shareholders, a niche international tax point.
Right. And energy credits. Always lots of action there.
Definitely. Extensions and modifications for a whole bunch of them.
Yikes.
Carbon capture, sequestration, clean hydrogen, advanced manufacturing production, clean electricity production, zero-emission nuclear power.
Okay. The usual suspects. Any catches?
Often phase-outs involved. And new restrictions related to specified foreign entities and foreign-influenced entities.
Meaning, trying to keep the benefits domestic.
Seems like it. Preventing certain foreign entities, potentially state-owned or influenced, from getting these U.S. tax credits reflects national security or domestic interest concerns.
Interesting layer. Okay, one more business item. Rural real estate loans.
Yeah, a new exclusion from gross income for interest received on certain qualified loans secured by rural or agricultural real property.
For who? The lender.
Yes, for domestic lenders, banks, credit unions, insurance companies, there are criteria, and it sunsets in 2029.
Aimed at supporting ag lending in rural areas, I assume.
Seems likely. Could make those loans more attractive for lenders.
Okay. Let's move to tax-exempt organizations. Nonprofits, universities, foundations. Changes there.
Yes. For that excise tax on excess compensation over $1 million, they're modifying the definition of a covered employee.
Potentially pulling more people into that tax.
That's a possibility, yeah. Could broaden its reach.
And the tax on college endowments.
A big overhaul proposed there. A new tiered excise tax system on the net investment income of private colleges and universities.
Tiered. Based on what?
Based on the institution's endowment size relative to its student body, a student-adjusted endowment.
Okay, so targeting the wealthiest institutions more.
Potentially. Certain students are excluded from the calculation, and there might be an exemption for qualified religious institutions.
Right.
Also, student loan interest and some royalty income would now count towards that net investment income.
So expanding the tax base while tiering the rate, significant change. What about private foundations?
Similar idea, modifying their excise tax rates into a tiered system too, with higher rates for foundations with larger assets.
Encouraging them to spend down faster, maybe?
Could be the intent. There's also a provision to help employee stock ownership plans disregarding certain stock purchases when figuring if a foundation has excess business holdings. Could help transitions to employee ownership.
Okay. And UBIT, unrelated business taxable income.
Proposed increases there. Making tax exempts include amounts paid for qualified transportation fringe benefits in UBIT.
So things like parking benefits.
Exactly. And also income from selling or licensing names and logos.
Ah, like university merchandise deals.
Potentially, yeah. There's a limited exclusion for income from publicly available research, though. Overall, it narrows some UBIT exceptions, treating certain income more like for-profit income.
Reducing maybe a perceived competitive advantage. And corporate charitable deductions.
A temporary modification there, increasing the limit to 10% of taxable income, but specific rules on carrying forward deductions disallowed under the old lower limit could boost corporate giving temporarily.
Okay. Now, international tax. Anything major beyond that FDII tweak?
Yes, a potentially significant new provision. It allows for increasing withholding tax rates on payments going to individuals or entities in foreign countries deemed to have discriminatory taxes against U.S. persons.
Wow. So punitive withholding against countries with unfair foreign taxes?
That's the concept. It defines what counts as a discriminatory country or tax, sets the potential percentage point increases for withholding, and outlines exceptions.
That sounds like a pretty powerful tool to push back against perceived unfairness.
It could be, yes, a more assertive stance on international tax issues.
All right, last big category, IRS and tax administration. What's changing there?
A few things related to eligibility for the premium tax credit, the ACA subsidies.
How so?
New restrictions treating certain lawfully present non-citizens as ineligible. And also disallowing the credit during periods someone is ineligible for Medicaid, specifically due to their alien status.
Okay, appears to be tightening eligibility based on immigration and Medicaid status.
That seems to be the focus. Also, new reporting for remittance transfer providers, businesses sending money internationally related to a credit for some of those transfers. Better tracking, presumably.
And AI, is the IRS getting Skynet?
Not quite the IRS, but HHS Health and Human Services. The bill mandates using AI tools to reduce and identify improper payments in Medicare Parts A and B.
Okay. Using tech to fight fraud and waste in Medicare.
Yeah, includes hiring AI vendors, data scientists, recoupment efforts, reporting to Congress. It's a broader government trend.
Makes sense. Now the Employee Retention Credit, ERTC. Lots of issues there. Any enforcement?
Oh, yes. Several provisions. Increased penalties for ERTC promoters who aid tax understatements.
Going after the bad actors.
Right. Treating due diligence failures, not checking eligibility properly as knowing about improper claims.
Ouch. Raising the bar for promoters and preparers.
Definitely. And extending the statute of limitations for the IRS to audit questionable claims and make corresponding deduction adjustments. Clearly cracking down on ERTC abuse.
Seems necessary given the scale of the problem. What about the Earned Income Tax Credit, EITC?
A proposal to create a voluntary EITC certification program.
Voluntary. How would that work?
Outlines getting a certificate, consequences if you don't get one when required, penalties for misuse, and a task force to design a private data match system for eligibility verification.
Trying to reduce errors and fraud in the EITC program, sounds like?
That appears to be the goal. Streamline for eligible folks, catch improper claims.
Okay. And something for hostages.
Yes, a provision to postpone certain tax deadlines for hostages and individuals wrongfully detained abroad.
That seems like a compassionate measure.
It does. Includes refunding or abating penalties paid before enactment. The Hostage Recovery Fusion Cell would be involved. Provide some much-needed relief in terrible situations.
Good to see. What about terrorist financing?
New rules allowing the Treasury Secretary to designate terrorist-supporting organizations and deny or revoke their tax-exempt status.
A direct tool against financial support.
Yes, defines the organizations, outlines designation procedures, chances to cure the designation. A significant step in that area.
And direct file. The IRS's free filing system.
This is noteworthy. The bill explicitly directs the termination of the IRS direct file program.
Terminate it, but it just launched nationwide.
Right, and it mandates creating a task force to design a public-private partnership to replace both direct file and the existing free file program.
Wow, okay. A major shift away from a government-run system towards a partnership model. That will spark debate.
No doubt. The goal is presumably a more effective, widely used free filing system, but the approach is changing.
Okay. And finally, cyber attacks. Is there anything new or just a reminder?
More of a reminder in the context. While not a new provision in this bill, it highlights that businesses hit by cyber attacks can often deduct related costs under existing law. Section 162, ordinary and necessary business expenses. The Coinbase example was mentioned in analyses.
Right, so the existing code can adapt somewhat to new risks like cyber threats.
Exactly. It underscores the relevance of current law to evolving business challenges.
So, okay, we've covered a ton of ground here. If we try to wrap this deep dive up, the big themes from this big, beautiful bill.
Yeah, definitely major shifts in individual taxes, standard deduction, exemptions, CTC, lots of business incentives and adjustments, especially around R&E and investment.
New healthcare things like choice arrangements, fitness expenses treated as medical, significant changes for tax-exempt endowments, UBI.
And important IRS administration and international tax shifts. Enforcement focus, the end of direct file, the discriminatory foreign tax provision.
It really touches almost every corner of the tax code. What stands out to you as particularly, I don't know, surprising or noteworthy?
Well, the interaction between the higher standard deduction and the new itemized deduction limit. It's interesting how that could shift taxpayer behavior. And the Mega accounts pilot. That's just completely new territory.
Yeah, the mega accounts were my aha moment too. Such a novel concept for early asset building. And I think that international tax provision targeting discriminatory countries is pretty bold.
Definitely. So for you listening, the key is to think about how all these potential changes, individual, business, healthcare, might connect to your own situation.
Your personal finances, maybe your business operations, or just the wider economy. It's complex, lots of moving parts.
And really, this deep dive is just scratching the surface, isn't it? This bill is just starting its journey.
Exactly. It'll face tons more analysis, debate, probably changes as it goes through Congress, so keep seeking out more detailed info, keep watching how it develops.
Absolutely. This is just the beginning of the conversation.
And maybe one last thought to leave you with. Given everything we've touched on, the sheer scope of this, what do you think is the single biggest potential long-term impact this bill could have, if enacted, on the future of the U.S. tax system and the economy? Something to chew on.
Definitely food for thought.
Thanks for diving deep with us today.